Hi guys, how's it going? Okay, we'll get started. All right, so my name is Josh Zweig. I'm a CPA, CA, LPA. It's a lot of letters saying I'm a chartered accountant, certified professional accountant, licensed public accountant, meaning I can sign off on statements. I've spent about 7 years in public practice. For a picture of me, I'm that smiling guy on the About Us page on the LiveCA website. Before we get into the actual presentation, just a little bit about LiveCA. LiveCA, we're Canada's first online chartered accounting firm. So every business owner should be able to connect with their own chartered accountant whenever, wherever. That's our philosophy. The idea is for you to meet face-to-face with your chartered accountant. So we're looking at modernizing the way people think about their accountants. So no travel times. You don't have to drive down to your CA's office to go and see him. You can just meet your CA from your comfort of your home or office. Efficient workflow. We don't work with paper. We don't have printers. Because of that, we're actually able to do work far more efficiently when we do it online. Also, no mahogany desks. So our philosophy is that we want to keep accounting friendly. We want to keep it accessible and simple. And also, accountants who know technology. So the days when you could go to Business Depot and pick up that copy of QuickBooks and put into your computer, and put in the CD-ROM, load the software, and that would be your accounting software for the next 5 years, that's no longer applicable. Choosing the right accounting software is a dynamic process that you should visit all the time. There's so many apps out there today that can help your business. In the past couple years, emergence of cloud accounting software like Wave, like FreshBooks, like Xero, have really changed the shape of the industry. You can virtually automate many of the processes in the accounting side of your business. So it's a good idea to revisit all the time your accounting software and see what else is out there that you can use to improve your efficiency in your business. And that's why we say technology to match your business needs. Your business needs are always going to change as your business grows, and there is probably some technology out there that's going to match those new needs. And when you do that, you realize efficiencies and grow your business. So your accountant is no longer just a numbers guy, but also a technology guy. And the more you can rely on your accountant to give you proper accounting technology advice, the more value he can really add to your business. Okay, so let's get into the agenda for today. Firstly, we'll talk about the honor system. So what really is a tax tip? You see this all the time, tax tips. So what does that mean? Next, we'll talk about this concept of reasonability. It's going to be our guiding compass when it comes to preparing a tax return. We'll get into 5 tips. There's tons of tax tips out there, but I'm just going to give you 5 in this. This will be about a 20-minute presentation, this whole thing, and then we're going to conclude. I should just say before we get into it as well, if you have questions, shoot them through the question window, and we'll get to them at the end of the presentation. So the Canadian tax system. So the Canadian tax system is the honor system. The Canadian income tax the system was introduced in 1917, and it was that employees and employers could remit to taxes on their own volition. So at the end of the year, basically you'd give your share to the tax man. Now, as you can imagine, people were cheating. And that's when, in the 40s, this withholding tax was introduced on employees, which is kind of like the system we have today, which is you don't get that. Let's say you're meant to get $2,000 every 2 weeks. You actually don't get the $2,000 if you're an employee. You get back $2,000 less deductions for CPP, for EI, for taxes, and those kinds of things. So there's deductions that come straight off your paycheck, and that's sort of a withholding tax. And that's why at the end of the year, you claim back the taxes that the government took, which is the named tax return. So claiming back the taxes that the government has docked from your paycheck. So that's for employees, but the honor system, this golden rule of tax, has still remained in place for businesses. So if that's the case, then you think, okay, well, there's got to be some sort of mechanism out there to prevent businesses from cheating. And that's, of course, the CRA audit. So the CRA audit in the income side, they'll come in and they'll check, let's say, invoices. They'll try to match those invoices to your bank deposits and say, okay, well, you billed $100. Did you receive $100? They'll check your net assets. So they'll say, do you have a nice car? Do you have a nice house? Well, if that's the case, how is it possible that you only made a few $1,000s last year? On the expense side, they'll check receipts. They'll say, okay, give me those meals receipts. Then they'll check it to your bank statements. They'll say, well, let me see that 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 receipt actually came out of your bank account. You actually did pay for that. And then the last thing is this reasonability check. And then this is what we'll talk about as we move through the presentation. It's going to make more sense. So what is a tax tip really? Well, there's a tax choice, which is abusing the honor system. So you could say, okay, well, I made $30,000 in cash sales. I'm only going to pay my return $20,000. Now, that's just not declaring income. Do you need to be an accountant to do that? No. That's not really a tax tip. That's more of a tax choice because it doesn't take much skill to just abuse the honor system and pick a different number. Same thing goes with declaring a personal expense as business. So if you took the family to Disney World and you want to put that as a business expense, sure, yeah, you can do that and try to sweep it under the table. But that's again a tax choice. You don't have to be an accountant. You don't have to know the tax system to be able to make that kind of tax choice. What we're going to be talking about today is a tax tip. So the tax tip is using the system to your advantage. And that means understanding the concept of reasonability and understanding how to use existing tax laws to your advantage. And you'll see that once you understand this concept of reasonability and once you understand some of the tax laws, you can actually save significant tax dollars, and then you won't have to make a tax choice. You can just use a legitimate tax tip. So we talked about this, but how does a CRA know you're cheating? Well, you could say, okay, well, I'll fake receipts. I'll write some receipts in a napkin, and I'll give that to the CRA. Hey, I had these meals and these meals expenses. Or you could say, well, look, I have a cash business. Most of the stuff comes in cash. It doesn't hit my bank account. Cash that comes in, I use it to pay other expenses. So there's no way for them to know how much I made. I also live a modest lifestyle. I don't have a big house. I don't have a big car. So in that respect, no one can know how much money I really make. And again, and this is where the concept of reasonability comes into play. So why is reasonability important? Well, reasonability is going to dictate if you are selected for an audit. It's also going to determine if an expense is deductible. And finally, it will determine how much of an expense to actually deduct. It's important to note that reasonability is a relative term. It's relative to the amount earned, so depending if you earn $20,000 a year, 100, or a million. It's relative to the industry. It's going to depend if you're a marketer or a family doctor or a gardener or a construction worker. But reasonability is an art, not a science. There is no rule of thumb when it comes to if something's reasonable, but as we go through these tax tips, you'll get a better idea of what it means for something to be closer to reasonable than not. So let's get into the tax tips. Tip number 1, home office. So what is a home office expense? Well, the CRA allows a deduction for home office expense. No matter what your business, you'll likely work at home in some shape or form. So whether or not that's actual full office in your house, or whether that's just checking the BlackBerry when you get into the kitchen, that's up to you. But you're still going to be working from home in some shape or form, and for that you actually get a deduction. So how do you do this? Step 1, you calculate all your home-related expenses. So if you own a home, you take your property taxes, your mortgage interest, your heating, your hydro, your water, your cable, internet maintenance, insurance, this whole sort of total of home expenses, and you add them up in let's say, a spreadsheet. Or if you rent your home, rental payments, utilities, maintenance costs, cable, internet, same sort of deal. So you take all these home expenses, and then you take the total percentage of your office space in your home. So you're meant to take the total square footage of your office over the total square footage of your house, and you come up with a percentage. And then finally, in step 3, you multiply those total home expenses by the percentage that your home office takes, and that's your total home office expense that you're able to deduct in your return. Again, this is one of these hidden expenses because you're not going to necessarily see this home office expense come out of your bank account, but rather it's something you can add to your return. So for all the accountants out there, you can then credit shareholder loan and debit home office expense. Or just basically, if you're not incorporated, just add this expense onto your return. So you might ask, well, how am I supposed to keep track of all these home expenses? I've got tons of home expenses that, I don't want to start keeping, to the penny every single bill that comes in. And further, I'm not going around with a tape measure and measuring my office space. And maybe I would do work in the kitchen. And so, what am I supposed to take, like, one chair of the kitchen and measure that? I mean, how do I know if the amount I booked is okay? And so here's a tax tip, which is use reasonability as a guideline. So how do you calculate all the home expenses? Well, you can estimate. So keep your receipts if necessary. It's always a good idea to keep organized if somebody asks. And how do you know if the amount is okay? Well, it's going to be relative to the industry. So, for example, if you're, let's say, a construction worker and you spend most of the time outside doing contract jobs around the city, and really you only answer a few emails when it comes home. When you come home, then the amount that you can book for a home office might be smaller than, say, a psychiatrist that has a full working office in the house with a couch and all, and actually accepts patients there. So that psychiatrist's office might take a lot more space and then more use, so the home office expense would be more than the construction worker or contractor that doesn't really use the space. So that's relative to the industry. Now, relative to the earnings, well, you might book a home office expense of $3,000 or $4,000 if you make $100,000. On the other hand, if you're only making $10,000 and you book a $3,000 or $4,000 office expense, that might raise a flag. So it's going to be also relative to how much you earn. If you really want a hard number, I don't like giving hard numbers in this kind of case, but I've seen the low end about $1,000 for booking a home office. Mid-range is about $2,000. And again, if you get more use out of your home office, like the psychiatrist with actual office space, you might be on the higher end of $3,000 or $4,000. And again, if that's your full office and you're accepting clients, well, it might even be higher than that. So let's talk about the travel allowance. So there's two methods to calculate travel expenses. One is a direct method, and the other is an indirect method. For the direct method, this keeps track of all expenses related to travel. So this might be more familiar to you, which is you keep track of your gas receipts, your insurance, your maintenance. Anytime you have some sort of auto expense, you keep that receipt. Now, I can think of the times I went to fill up my car and just shove that receipt in the glove compartment or in that little cup holder, and it gets soaked with coffee, and the next thing I know, it's gone. So as you can imagine, by the end of the year, you may not have all the records, and it's also time-consuming to keep all the records of all the travel expenses that you've had. So the indirect method is where you calculate the total kilometers driven for business, and you multiply those total kilometers by the CRA reasonability rates, which we'll get to in a second. Now, the advantage of this is it's far easier to keep track. It's also a robust model, so the CRA amounts do include, they sort of take into account what it would normally cost for insurance or gas or even amortization in your car. That's kind of all built in to their model here. And here are the rates for 2012. It's 53 cents per kilometer in the first 5,000 and 47 cents per kilometer thereafter. So let's take a look at how this actually works out. Well, Jim has a marketing company, let's say, and Jim visits clients at their offices but doesn't keep track of receipts. So Jim is going to make an estimate. He's going to say, well, I think I drive about 100 kilometers per week, which is going to translate into 5,200 kilometers a year. So Jim's auto allowance is 5,000, and the first 5,000 kilometers at 53 cents, which is 26.50. Then you take the other 200 kilometers over that 5,000 at 47 cents, you get 94 bucks. So the total is 27.44. Again, this isn't a number that's going to show up anywhere in the tax on your actual bank statement, but rather, yet again, you can credit, share it, or loan, debit the expense, or just throw it into your tax return as an additional travel expense. So the tax tip is to use reasonability as a guideline. Officially, you're supposed to keep a logbook. The CRA wants a logbook of every business kilometer you've driven. Have I seen anybody do that? No. But what I have seen is the CRA say, hey, I need some backup for this travel expense. Who did you visit? So it's a good idea maybe, let's say, once a month to have this running Excel file of the people that you visited over the course of that month. And since you probably have your customer addresses somewhere, this is always good if the CRA says, well, why is this travel so high? You say, hey, well, look, these are all the customers I visited each month. I've got all the addresses. If you need it, you can see them driving around the city or the country or whatever it is and clocking up all these kilometers. Of course, it's also going to depend on this reasonability concept, which is the nature of your profession as well. So if you're a marketer like Jim, yeah, it makes sense that you're driving around to make sales calls. But as a family doctor in a walk-in clinic, you're probably not driving around to see patients in the same manner. So it really depends on what you do, and that's going to give sort of support to your claim when you submit your return. So let's talk about timing as tip 3. So what does it mean when I say timing? Well, you pay your taxes on income earned in a tax year. But for transactions that are close to year-end, you actually may have control on when to include those transactions. And here's what I mean. So let's say Jim has a T-shirt business, and he receives orders towards the end of December. So there's two scenarios. Let's say that Jim ships these T-shirts out before year-end. So December 28th, let's say Jim ships out a full load of T-shirts for 10 grand. So that 10 grand has to be included in revenue in that tax year. If Jim's not incorporated and it's 2012, Jim has to pay tax on that additional 10 grand because it's included in that tax year. Now in scenario 2, let's say Jim says, okay, well I'm gonna close December 28th. I'm going to ship January 2nd. Well, all of a sudden that 10 grand is included in the following tax year, which means Jim's effectively deferred tax by a full year. So whereas Jim would have had to pay on his tax return the tax on 10 grand, which let's say is in the highest tax bracket, unincorporated, might be $4,600. Now he doesn't have to pay that tax for another year, right? So you've effectively deferred tax for a full year. So the tax tip here is to, again, stay reasonable. So you need to consider when title passes to the customer. If you're a goods business, you can't, the fact that you get paid, let's say, in January, but still ship the goods in December, you can't say to the CRA, well, hey, I got the money in January, so I'm going to claim this in January. CRA may say, hey, well, no, you shipped the goods in December. Title passed to the customer in December, so therefore we're not going to let you do this. So consider when the title passes to the customer. Also be consistent. So if you've got sales of 10, 10, 10 each month, suddenly December comes and it's 0 and January is 20, that might raise a flag. So there's got to be some concept of consistency and also planning. So if you know that you have an order, a customer orders typically towards the year end or something, or if you're a service business that a customer, you typically have a file that you build towards the year end, you may consider billing, a couple days later and therefore deferring that amount to the following year. So it just takes a little bit of planning before, and perhaps you can get a tax deferral, so you don't have to pay that bill for a full year. Tip 4, meals and entertainment. So what is the meals and entertainment expense? Well, the CRA allows a 50% deduction for meals and entertainment expenses, except it's one of these gray areas in tax. And that's because, well, there's many cases in which there's an argument for either a personal expense or a business expense. So take Jim again. Let's say he's got a personal relationship with a lot of his clients. A lot of his clients are his friends. And he goes out with them for drinks and occasionally talks business. Let's say once a week Jim meets his buddies for drinks, and then there he kind of schmoozes and talks business. So you might say, well, that's not fair. He goes out with his friends. But there's also an argument to be made that the drinks are a business expense. Maybe Jim is a marketer, and in fact, how he gets business is by wining and dining his friends and his acquaintances. And through that's how he builds his network and makes money. Maybe that is legitimate. So, okay, so how do we support this meals and entertainment expense? Well, officially the CRA requires you to keep all the receipts and write in the back the purpose of the meeting and who attended. Again, how many people do this? Very few. But what you could do is keep a running Excel, same kind of deal, of the people that you've met through that month. And then, if the CRA challenges your meals and entertainment expense, you can say, well, look, here's a list of people that I met that month. And that might be good enough to support that expense. Also be reasonable, meaning deduct expenses relative to the industry and income level. So again, for a marketing firm, it makes sense to wine and dine prospective clients. The CRA might say, sure, that is a reasonable business activity. On the other hand, a family doctor, you're not wining and dining patients, or it's unlikely. So the meals and entertainment expense should be relatively low. Last tip for the day, let's talk income splitting. So what is income splitting? Well, income splitting is where you pay other family members a salary. And the purpose of that is to reduce both corporate taxes if you're incorporated and personal tax obligations. So let's take a real example here. Let's say that Jim has so Jim, we'll talk about if Jim's incorporated and not incorporated, but let's say he's got a company now and takes from the company a salary of $130,000. Let's also assume Jim's wife helps out with some of the bookkeeping, and now there's a profit of $10K left in the company. If Jim's not incorporated, we'll say that Jim just made $140,000. But let's examine this corporation scenario now. So in scenario 1, when Jim takes out the salary of $130,000, that's what he needs to pay tax on. So he'll pay on his personal side, he'll pay personal income tax on $130,000 he took out. The company, on the 10K that's left, the company will pay corporate tax at the corporate rate, and so it's about, let's say, $15.50 in Ontario. So that's what the company will pay. Now, let's take scenario 2, which is that Jim is going to take an extra 10K for the company, which also applies if Jim's not incorporated, so he's made basically $140,000. So at the top tax bracket, Jim's actually paying an additional $4,600 on this 10K. Sure, the company is not going to be paying any tax, so there's no profit in, but you can already see the difference between scenario 2 and scenario 1, where there's this $3,000 difference, which is significant, especially if we're going to talk more than 10K. Scenario 3, here's the income splitting. We'll say, okay, we'll give Jim's wife a 10K salary. So what happens here? Well, the company now pays no tax. That gets rid of the 10K profit. Jim pays no additional tax because there goes his, because he's still in the 130. And assuming that Jim's wife has no extra income, she pays, or she actually pays nothing because she's below the personal threshold. And if Jim's not incorporated, again, so Jim would still take the salary of 130 and give his wife 10 as opposed to Jim taking out 140. So Jim has really saved $4,600 here. Again, a significant tax savings. So the tax tips to keep in mind when income splitting: the salary has to be reasonable. If Jim's wife is part-time bookkeeping, a salary of $60,000 or $70,000 will probably not be reasonable. So you kind of have to be reasonable relative to what she's doing and to, or what whoever's doing that you're doing income splitting with, and the industry. Also important to be consistent. So the fact if Jim's wife is doing the same bookkeeping functions each year, she shouldn't be making 10 one year, 50 another year, 20 another year. It should really be consistent. Yeah, maybe each year you can go up a little bit, but again, it shouldn't fluctuate majorly from year to year. That can be a flag. Consider other income. Income splitting really works when there's this gap in tax brackets. So if Jim's in the highest and his wife is in the lowest, you've got a massive opportunity for income splitting. If both parties are in the same boat, they're in the same tax bracket, it may not make sense. So there's a little bit of a calculation that you've got to do there. Consider ages. I've seen people try to pay their 3-year-old salary for $10,000. It's unlikely a 3-year-old is going to add that much value to your business, to your life probably, but to your business not as much. So you want to consider ages. Maybe it's okay to pay an 8-year-old a couple $1,000s for filing, but perhaps that much younger than that, it's going to be hard to justify that to the CRA. And finally, payroll deductions. Always remember that if you are going to do income splitting, that payroll deductions, you need to make deductions for, EI, CPP, income tax, and remit that on a regular basis to the CRA and do your T4. So there is a little bit of extra work involved, but it's certainly worth it, as we can see in the example with the tax savings. So that's really it. The summary here. There's a lot of considerations to make when filing a tax return. Sometimes it's not as simple as it looks. We talk about some of these hidden expenses like the travel, which is not going to hit your bank, and same with the home office. Perhaps income splitting. These expenses are not necessarily, real expenses that you'll see cash coming out of your account. They're expenses that are legitimate, but not the same type of cash expenses as buying an office, an office chair. Reasonability is an art, not a science. And here's where it helps to consult a professional. You may not know whether it's okay, to book that much travel, book that much meals and entertainment. And that's where a professional can add value and say, hey, it's okay because I've seen 100 doctor's books, or I've seen 100 restaurants, and I know what a reasonable meals and entertainment expense looks like relative to the industry and how much you're making. So that's kind of what the some part of a value that a professional brings to the table. Implementing the right strategies, the savings can be significant. I hope you just got a taste here of if you use the right tax tips, you can actually save a ton of dollars. Which brings it to the last point, which is use tax tips and not choices, meaning there's a lot of tax dollars to be saved with the right strategies, so there's no need for tax choices. So thanks very much for attending. You'll get a follow-up email tomorrow, so you can just respond to that. Any questions about any of the topics covered, any other tax tips, feel free to shoot me an email at josh@liveca.ca or give me a shout at the number of the website, or you can always book a free consultation. Thanks again, and now I'll save a couple minutes for questions. Just shoot them to the question window.